Chairman Johnson. Governor Tarullo, I'd like to talk to you for a moment. 3 or 4 years ago, in 2009, you said that, I quote, limiting the size or interconnectedness of financial institutions was more a provocative idea than a proposal, and you said that in the context that there weren't particularly any well-developed ideas out there. And since then, as we've talked, I've introduced legislation to limit the non-deposit liabilities of any single institution relative to domestic GDP. I've worked with Senator Vitter on that proposal, and we are considering to see, I think, more bipartisan support. Tell me how you have evolved, your thinking has evolved. Your more recent statement seems like it has. Tell me how your thinking's evolved from 2009 and why that is.
You're absolutely right, Senator Brown, that my observation back in 2009, I think, was that people would say something like, break up the banks, but there wasn't a plan behind it that allowed people to make a judgment as to whether it would address the kind of problems in Too Big to Fail and others in the crisis, and what costs associated with it would be. As you say, since then, a lot of people have generated a lot of plans. And I think they probably fall into 3 categories. The first category is really kind of a variant on things we already do. Strengthen the barriers between insured depository institutions and other parts of bank holding companies. Make sure that some activities are not taking place in the banks. Make sure that there's enough capital in the rest of the holding company, even if they get into trouble independently. Don't just think in terms of protecting the IDI itself. Interestingly, those are a big part of some of the European proposals, like the Liikanen and Vickers proposals. As I say, to a considerable extent, the U.S. has already gone down that road, and indeed Dodd-Frank strengthened some of those provisions. The second set of proposals is what I'd characterize as a functional split. So saying that there are certain kinds of functions that cannot be done within a bank holding company. Obviously, Glass-Steagall was exactly that kind of approach. It separated investment banking from commercial banking. And here's where there are some proposals out like this. Now, they sort of vary. Some of them would allow underwriting but not market making. Others might say, nothing at all other than commercial banking. I think the issues are kind of on both sides. On the one hand, we have to ask ourselves, if we did that, would it actually address the problem that led to the crisis? As Senator Johnson was indicating in his introductory remarks, it was the failure of Bear Stearns, a broker-dealer, not a bunch of IDIs or relationships with IDIs, that precipitated the acute phase of the crisis. And the second issue, obviously, is what would be lost. Are there valuable roles played when, for example, an underwriter also makes market in the securities which it underwrites? And I think most people would conclude that there are. The third kind of example is embodied in your legislation, and I think in some other proposals, which focuses on the point that I tried to make at the close of my introductory oral remarks, what I would think of as the unaddressed set of issues. The unaddressed set of issues of large amounts of short-term, non-deposit, runnable funding. And I think here, and speaking personally now, my view is that's the problem we need to address. I think what your legislation takes one approach to addressing it, which is to try to cap the amount that any individual firm can have, and thereby try to contain the risk of the amplification of a run. There are other complementary ideas, such as restricting the amounts based on different kinds of duration risk, or having higher requirements if you have more than a certain amount. There are even broader ideas, such as placing uniform margins on any kind of securities lending, no matter who participates in them. I think from my point of view, the importance of what you've done is to draw attention to that issue of short-term, non-deposit, runnable funding. And that's the one I think we should be debating in the context of Too Big to Fail and in the context of our financial system more generally.
Thank you. And Mr. Chairman, if I could just a couple of quick comments. One is, that we've seen since, and thank you for that evolution in your thinking and the way you explained it. When Senator Kaufman and I first introduced that amendment on the floor in 2010, it had bipartisan support, but it obviously fell short. We have seen from columnists like George Will, and a Wall Street Journal op-ed columnist, and a number of others sort of across the political spectrum, including colleagues that are, way more conservative than I am on this in this body, come around to looking at this pretty favorably. So we've seen a lot of momentum, and I appreciate your thinking. Second, I wanted to bring up really quickly, Mr. Chairman, and I will not end with a question, but the last week, Governor, I received the Fed's response to a letter regarding the imposition of Basel III on insurance companies. Senator Joe Johans and I sent with 22 of our colleagues last year. Senators Johnson and Crapo have sent a letter yesterday to the Fed on the insurance issue, and you and other Fed officials have stated several times you believe the proposed rule adequately accommodates the business of insurance. We respectfully disagree. I won't ask for a response now, but we will work with you on that if we could. Thank you. Thank you, Mr. Chairman.